Welcome to Bunnex Investment Group. In this course, you'll learn how to use candlestick reversal patterns professionally. Before we go any further, be sure to be part of our free signals Telegram channel. I'll leave the link in the description box below. So here is the course outline. We are going to start off on continuation candlestick patterns, then M and W setup candlestick patterns, one leg reversal candlestick patterns, and last but not least, hourly candlestick secrets. Make sure you stick up to the end so that you can fully comprehend and be able to apply all these in your own trading. So let's now talk about continuation candlestick patterns and where to look for them. Firstly, what candlesticks do you look for when you want to jump in a running trend? I'm sure there are several traders who just buy and sell without any confirmation. That is a little bit dangerous because you may get trapped within the market. So when the market is trending, we look to jump in whenever there is a pullback. So we need to see a pullback issued in a sustained trend. There are a set of candlesticks available that shows continuation. To understand, we say we need to see what we call reject and continue. So we are saying in a sustained trend, we need to see a pullback, and at that pullback, we need to see reject and continue, right? So the short phrase to hold here is reject and continue. So continuation patterns mostly comes at yesterday's high or yesterday's low, abbreviated as YL or YH. So this occurs when yesterday's was a day of consolidation. In this particular case, we are saying a day of consolidation is a day whereby the opening price of that particular day is almost equal to the closing price of that same day. So day of consolidation, in short, is opening price almost equal to closing price. And we are saying the most powerful candlestick reversal patterns are hammers and inverted hammers for continuation patterns. So we are saying hammers and inverted hammers are the most powerful reject and continue candlestick reversal patterns. In this particular case, we have Tuesday, which ended as a day of consolidation. Tuesday set its low at this point, abbreviated as YL, and on Wednesday, we actually saw the market coming back to the yesterday's low, and at this point, which has a red dot, is where we expect to see hammers and inverted hammers. So a hammer looks like this. It's a candle with a long wick and a head that looks like a real physical hammer. In this particular case, we actually can see that the trend is up, or we are saying the cycle hasn't completed yet, and in that move, we had this day, a day of consolidation, opening price almost equal to closing price. There is no drop or rise in that particular day. So if that happens within a trend, we expect to see retest of yesterday's low. In this particular case, we had a hammer at yesterday's low. So in this particular case, we are saying this is reject and continue. So the short phrase to hold here, as I've said earlier, is reject and continue. In this particular case, it's now an inverted hammer, which is an inverse of the previous candlestick reversal pattern. We are saying it's a candle with a very big wick and a small body at the end of it. In this particular case, we had a downward trend, and we had a day of consolidation, opening almost equal to closing, and if this happens within a market maker cycle, we expect to see retest of yesterday's high, and at that point we need to see reject and continue. In this particular case, they came back to yesterday's high and they actually gave this particular candlestick at this point. Inverted hammer was issued and the market actually went our way. So before we go any further, we are saying the powerful candlestick reversal patterns for continuation are hammers and inverted hammers, which actually signifies reject and continue. Then our next part is M and W setup candlestick patterns. We know that M's can also be called double tops or double bottoms, and they occur a lot on the charts. Entry triggers must be confirmed patterns. In this particular case, we are saying at this point, that is where we are interested to get in. But the market can or has the ability to actually pass through and go away from this first leg level or first leg zone. Therefore, we need to have properly confirmed candlestick reversal patterns at this point. So these patterns are obtained at the first leg zone. This is the first leg zone that you protrude in the future and expect to see the market respect by issuing a candlestick reversal pattern. The most powerful patterns are the engulfing patterns on the second leg of the M or W pattern. So what are engulfing patterns? They are patterns that engulfs the previous candle. In this particular case, this is a bullish engulfing pattern. We look for it at the second leg of a W. In this particular case, we are saying the first leg has been issued at the first leg level. We see a red candle being engulfed with a green candle like this. We expect to see the market to push up from that point. Then in this particular case, we are saying this occurs at the first leg of the M pattern, and we call it a bearish engulfing pattern, whereby the green candle is fully engulfed with the red candlestick, and we expect to continue. So it's basically an entry trigger when we see closure of the engulfing pattern, and still on that point, make sure you always enter your trades on candle closures, because the market makers can trick you and end that particular candle as a wicked candle. So we are saying we look for these engulfing patterns at these zones, first leg level, and this double top or double bottom is not just a pattern that you should guess or take any pattern that has been issued. It should be a pattern that is in line with the market maker cycle. In this particular case, we had a W, and an engulfing pattern is actually expected at this point. Real market examples, we are saying it's actually after level 1, level 2, level 3, where we fully expect to see an M pattern or a W pattern. We saw the first leg, and then at the second leg, in this particular case, someone would have been induced by seeing this long wick candle, but to see the market keep on going down. Then we had a bullish engulfing pattern that was issued. Green candle fully engulfing the red candle, and the market went our anticipated way. In this particular case, we also had the first leg level, and at the first leg level, we actually had a very beautiful bearish engulfing pattern, and the market went our way again. So this was taken from USDCAD, and the date was 5 April 2023. Then our other part is one leg reversal candlestick patterns. In some cases, enough traders are trapped such that market makers cannot pull back for second leg. In this particular case, we are saying if they issue one leg and if they try to come back to the second leg, those who were trapped as buyers will be able to close off their positions. Therefore, the market will only give one leg and run away. So in these forms a 2 candles MOW pattern called railroad tracks at the end of the market maker cycle. So we are saying the conditions to enter one leg are or should always be cycle now at level 3, market in the London or US session within the rightful trading times. A clear railroad track has been issued and you enter without fear. This particular case, we are saying railroad tracks are candles which have almost equal bodies, red and green, meaning it's now an upward move, green and red, meaning it's now a downward move. They can be in multiples of 2. We can see 4 candles, and the last one being the one that dictates the direction of the market. So railroad tracks or RRT are basically equal opposing candlesticks at the rightful zone of market reversal. We are saying at the end of a cycle. So here's just an example. at the end of a cycle, level 1, level 2, and level 3 at the end of the cycle. That is where we expect to see an RRT, and the market went away. We could not get a second leg. So if a RRT has been issued at the end of the third level, that is when we actually enter the market without fear. Here's the last part, and one of the most important ones. We need to highlight on the hourly time frame candlesticks. The opening and closing of an H1 candlestick gives important data of how the market will flow in that particular hour. So our concept that we are going to take from this part is when an H1 candlestick opens without a wick. For instance, if it actually opens and probably it's a green candle, bullish candle going up like that, we always anticipate it to take its low before closing that hour. So we are saying if it opens without a wick, always anticipate it to create one before it closes. So in this particular case, we'll actually see price dropping and create a wick like that. So do not always get trapped with H1 candles. Like in this case, we can see a candle opens with no wick with a flat base like this. Price of this yellow line is actually moving or pumping to the upside, and you can get in with FOMO, and FOMO meaning fear of missing out, but later to see your prices at this point and it retraces to create a wick like this. So your position is at this point, probably you'll be taken out. So always make sure before you enter, you check the hourly candlestick to see if it has a wick. That way it has lesser probability of actually coming back to create one or to elongate one. So here's the summary of everything that we were talking about in this small course. We said hammers and inverted hammers are powerful at yesterday's high or yesterday's low. And we've said we come back to yesterday's high or yesterday's low if the market gave us a day of consolidation on the previous day. Engulfing patterns at second leg of MOW are most powerful candlestick patterns. Then RRT or railroad tracks at first leg are also powerful candlestick patterns. In conclusion, I always say Forex is a system designed by smart people to transfer wealth from the impatient to the patient. Always be on the right side. We have a daily Zoom market analysis that goes for $50. This will definitely help you if you are facing difficulties in actually analyzing the markets. On that note, we've come to the end of this lecture. Thank you for watching, and I'll see you on the next one.